Royal Caribbean Group is one growth stock down 54% that I think you might regret not buying on this dip here. I'm going to talk about why I think that's the case in this video. Starting with revenue. Of course, revenue collapsed in the aftermath of the pandemic. Cruise ships were forced to shutter their operations, and of course, that's the only way they make revenue. Royal Caribbean's revenue collapsed from over 9 billion down to less than 2 billion in from top to bottom. However, it is recovering strongly. Look at that bounce back here, 8.8 billion in its most recent year, and I suspect this will continue and this will persist. There's a lot of pent-up demand to make up for away from home experiences. We were cooped up indoors for what it seemed like an eternity. And now we just want people just want to get out and do things away from home. Spending on away from home activities is growing strongly in all categories. If you look at restaurants, theme parks, sports, concerts, bars, cruise ships, planes, all of that spending is increasing. And then when you look at things that people buy for at home consumption, that's falling, right? Computer sales just came out. The first quarter computer sales down nearly 30% year over year. So people are taking money, allocating more of their budget to away from home things. Royal Caribbean is going to benefit from that trend, and it already has been. Look at that bounce back. And so the company was generating very nice operating income before the outbreak, $2 billion in trailing 12-month operating income. That's recovering. It's on its way back there. I suspect it will be higher than where it was before because of all the price increases that were implemented, right? Across the board, companies like Royal Caribbean industry wide raising prices. So when customers return at the same level from before the pandemic, total profits, total revenue will be higher. And then, even more impressively, cash flow from operations will be much better. So before the outbreak, Royal Caribbean was generating near $3 billion in cash flow from operations in the trailing 12 month. That collapsed, of course, and then now it's recovered 481 million in the most recent trailing 12 months. Really good that it's back to being positive, but it's got more room to go. And as an investor getting in here, you get to capitalize on that recovery, on that bounce back. And that's going to be important because the company took on a lot of debt to survive the pandemic when it was forced to shut down. It went from around $10 billion in long term debt all the way up to $23 billion in long term debt. So it's going to need this cash flow from operations to pay down a lot of this debt. That's likely what it will use a meaningful portion of its cash flows on during the few years after the recovery. But given its strong cash flow generating potential, I suspect it will be able to pay down this debt, bring it back down to more manageable levels, and also be able to refinance this debt at lower costs once it shows lenders that it's back to full strength. So the key is for it to recover back to these levels, around 2 billion in cash flow from operations. Then it can really get this debt under control. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Finally, the last reason why I'll highlight for buying this growth stock before a rally is the valuation. Royal Caribbean is trading at a forward price to earnings of 18.2. 18.2. That's not really high, and especially when you consider that its operating profitability, its profitability is still way below its peak level. So I don't suspect its profits will be back to peak level this year. I don't think expectations from the industry are that it will recover back to that level this year. So you've got this valuation forward price to earnings considering this year's earnings, and then 2024 is also likely to be a really good year for Royal Caribbean earnings wise. So you've got that 2 years of earnings. So looking at it that way, if you buy it today, it could look like a good deal because next year earnings are going to be even higher. And then the following year after that, it's probably going to still be pretty good going forward because that pent up demand for away from home experiences, I don't think that's going to end anytime soon. I don't think that's going to end anytime soon. Now, I could be wrong, but based on all of the companies that I follow and based on what I'm hearing from those management teams, based on what I'm seeing from their figures, everything indicates that consumers are taking money away from the things that we do at home and spending more on things that we do away from home. Things that we do away from home. And you can look at all of the videos that I cover across the board from my travel companies that I follow, like Airbnb, Disney, Carnival, Hilton, Marriott, and those. And you can compare what's going on at those companies with what's going on with companies that benefited when people were spending more time at home. Think companies like Amazon, Peloton, Home Depot, Netflix, and those, right? So you can see that big difference between consumer budgets and you could see it in the numbers. You can see it in the numbers, and the numbers don't lie. And so for that reason, I think Royal Caribbean might be one growth stock you're going to regret not buying on this dip here. All right, thank you so much for watching. As always, I really, really appreciate your viewership. I couldn't have this channel without your viewership, so I really appreciate it. Thank you so much for watching, and I really hope I will see you again next time.